Okay, so here we have the gold chart in front of us, right? This is going to be a case study where we really dive into liquidity and fair value gaps. What's more important? Well, let's find out in the video. So this is a 4-hour time frame of gold, and we understand over here that yes, the structure is bullish, right? So we have a bearish low down here, and we have a high up here. So we have a high up here and a low. And so from here, we're going to be dissecting how you could have potentially bought last week the expansion, the bullish expansion up prior to Friday's meltdown, right? We had a very bearish day on Friday, but prior to that, price did move up, and we're going to be investigating how you could have got involved in that particular trade, right? So from here, we need to understand a couple of things where, yes, we're in a 4-hour discount, right? So anything below the 50% level over here is a discount, right? So anything below this is a discount. So let's quickly look at our 4-hour structure. Structurally, we are bullish. We have a structure low, structure high. We have a 50% level here. Anything below this is a discount. So let's quickly label that on. And in the discount, what do we look for? Well, we look for buys, or we look for higher prices primarily. So once we've got that out the way, we need to understand a couple of other things. The interbank price delivery algorithm seeks for two things. What does it seek for? Well, it's right in front of you. It seeks for fair value gaps and liquidity. Well, this case study specifically focuses on fair value gaps. So this blue box over here represents a inefficiency or a fair value gap. And so this movement higher, right? This entire movement higher from last week aimed to fill the fair value gap before melting lower. And we're going to dissect how you could take a buy trade, going up here. So now if we head down to the 15-minute time frame, right? Let's take a look at the price action from last week. Now, what is more important, fair value gaps or liquidity? Now, the question you want to ask yourself is, why are you even asking that question in the first place? Because you need fair value gaps and you need liquidity to actually be successful. But there's one thing that underpins all of this, and that is time. And I'm even going to write this over here. That is time. Now, the best way to understand time is really through experience in the market. So you need time in the markets to understand time. Remember that phrase. So to build your overall understanding of time, use case studies like the ones I'm providing at Liquid FX to help improve your overall understanding of these concepts. But how do we combine liquidity and fair value gaps? Well, there's a couple of things we're going to be going over, or a few things that we're going to be going over. So first we have the Monday Asian session over here, and the weekly open, of course, is at Sunday, just before midnight if you're in the UK. So this red line over here represents the weekly opening price. The weekly opening price. Now, why am I marking this up, and why is this price actually significant? So if we look at the Monday, if we look at the way Monday behaved, what we have on Monday is we have a bearish day, and we have some fair value gaps to the left of the screen, right? So from here, the first thing you want to understand from an ICT perspective, or just a general price action perspective, is that your low of the day, your low of the week, typically forms on Tuesday through to Thursday. This is something to understand. Typically, Tuesday to Thursday, is the expansion, right? So anything between that is what we're looking to trade essentially, right? So from here, what makes this a high probability trade opportunity is the fact that yes, number one, we are in a 4-hour discount, but number two, looking at this over here, you want to identify which liquidity pools have been swept, and essentially there's two liquidity pools that we as traders in the market need to focus on. The first liquidity pool is looking at previous day highs and previous day lows, right? PDH or PDL. Very important to understand, right? And this also corresponds with weekly highs and weekly lows. So you want to be looking at previous day lows and previous day highs. The second thing you want to look at is you also want to look at session highs and lows, right? Session highs and session lows. These are two of the most important and critical aspects to your overall trading when it comes to liquidity. Okay? So from here, we understand we have Monday's low over here. So this here represents Monday's low. And this gives us the major liquidity sweep we are looking for, right? So this is what we call a PDL, right? A previous day low that's been swept in the market. So this is what we call a major liquidity sweep. And I'm going to be teaching you in this video also how to build a checklist that you can employ into any particular market. So that's the first thing you want to look at. The second thing you want to look at is the fact that where are we relative to that weekly opening price, right? So the weekly opening price, notice how we are below it. So what we've had is we've had a sweep of liquidity, i.e. the Judah swing. This is the Judah swing over here, which I'm going to label in yellow. Now, what makes a Judah swing valid, right, is a couple of things, right? The first thing which makes it valid, right, when we're looking for an intra-week trade, we want to be priced below the weekly opening, right? Notice how we're below the weekly opening. So this is kind of your A plus checklist, right? This is your A plus checklist, right? So the first thing you want to look at, you want to look for price to be below the weekly opening for a buy. Of course, if it was a sell, you just flip the theory on its head. The second thing you want to look for is you want to look for a liquidity sweep. Now, liquidity sweeps are often, I mean, they're all over YouTube. Everyone's using liquidity these days, SMC, ICT, supply and demand. But what actually determines liquidity sweeps? Liquidity sweeps must be used in conjunction with time. And what do I mean by that, right? We don't just mean time of day. We also mean time of week or day of week, should I say, right? Monday liquidity is often swept on Tuesday, right? And what gave me the extra confluence in this particular case study itself, in this particular trade, was the fact that we have fair value gaps to the left, which were also mitigated on Tuesday. Another thing that makes it valid is that on Monday, we didn't quite see a clear break of structure over here. Yes, we had breaks of structure over here, minor breaks of structure. But what made this less probable to me was the fact that we have fair value gaps to the left. Tuesday is typically a day that sweeps Monday's liquidity more often than not. And that's something you want to take into advantage, right? Have you seen a liquidity sweep, right? In this case, we have seen a major liquidity sweep, and that's in the form of a PDL, right? Previous day low. Let me put that in capitals. Previous day low. This is incredibly important for you to understand. Now, once you've determined that, the next thing you're looking for is you're looking for essentially a shift of market structure. This is where things get more SMC based. You're looking for a shift of market structure, and you're looking for a fair value gap to qualify that shift of market structure. And this is essentially your A plus checklist. So let's take this over to the left so it doesn't get in the way of the charts. This is your A plus checklist, everyone. You're looking for a break of structure and a fair value gap after a major sweep of liquidity below the weekly opening for a buy. That is essentially the A plus checklist that I use. Obviously, things get more complex when it comes to POI selection on higher time frames, etc., right? But the overall model is essentially keying off a fair value gap qualified by a structural break after a liquidity sweep, priced below the weekly opening. This is essentially your A plus setup. And now from here, once you've identified that, from here, we're going to quickly go over the market structure shift, right? So we see a market structure shift just over here, right? Near the Judah swing, just above the Judah swing. And this is what validates the Judah swing itself. So let's label this the Judah swing. Now, this is known as the Judah swing or the turtle soup, or I like to call it simply a manipulation along with the power of three. So we have a power of three accumulation, manipulation, and our job is to catch the distribution. And how do we do that? Well, the first thing to understand is we have a clear shift of the market structure over here. So MSS refers to a shift of market structure or a market structure shift. After that, we're simply looking to key off a fair value gap. And where are the fair value gaps themselves? Okay, so yes, we see a very clear fair value gap just over here. So this fair value gap entry, if I label this now in blue, what makes it a valid fair value gap? Well, number one, the narrative, we're in a discount, right? So every fair value gap has to have somewhat of a narrative behind it. So if your fair value gap doesn't have a narrative, it's more of a gamble than an actual trade, okay? So from here, this fair value gap is valid as it's time-based, right? It's in New York session, right? New York AM session. The second thing that validates it is that it's below the weekly opening price, i.e. a good area to buy. The third thing is we're in a 4-hour discount. So notice how we're building a story in price. So this isn't just some random fair value gap that I brought from a chart. It's really integrated within our overall narrative of the markets. So once we have determined the fair value gap, from here it's pretty simple, right? If I zoom out on price, We simply key off the fair value gap over here, just like this. Now I had my stop loss just below the Judah swing. Yes, you can have it here as well, but I just personally prefer a slightly wider stop loss because I understand my risk and my risk to reward. But once you've got that in place, right, then where the next thing traders often ask me is, oh, where am I targeting? Where do you target? Where's the target? Well, simply put, if I get rid of this box, what do we have over here, right? We have a fair value gap. We have an inefficiency in price. What do we have over here? We have the previous week's high, sorry, and this is essentially liquidity. And if you've watched some of the previous videos or you have a basic understanding of price action or ICT or whatever you want to call it, the interbank price delivery algorithm, the IPTA, seeks for two things. It seeks for fair value gaps and it seeks for liquidity. These are the two things the market actually seeks for on any time frame. When you're building a target narrative, when you want price to go somewhere, it must be targeting either a liquidity pool or a fair value gap. Often it will be both. And this trade is a great example of that. Where essentially what we have over here is we have price. We want to target last week's liquidity pool. Yes. So yes, we want to target this over here, but our real target is this fair value gap over here. And price really, I think price just missed it, just below a 1 to 3. I believe this trade was. I think I banked 2.5R. Excellent. 2.5% trade, right? Looking to target the fair value gap to the left, right? So this is a quick overview as to how you can trade gold, essentially catching most of that weekly expansion from discount up to premium. Okay, so if you like this video, give it a like, give it a thumbs up. Let me know in the comments what other videos and what other tips you want to see from SMC or ICT or general price action, and I'll be more than happy to put them in the channel.